Hey everybody, welcome to Trading Capital's weekly sector analysis. Today is currently April 30th, and as we kick off this weekly sector review, we're just going to jump right into the technology sector. Obviously on the weekly chart here, you can see that the technology had a beautiful reversal off of this key COVID trend line of support. So that resistance line that many sectors and even the indices are fighting, at the moment, technology is actually bouncing off of that level and trying to break through the next resistance. Notice we have had a beautiful 3-week move up, beautiful consolidation right now, and technology at the moment is looking primed and ready to continue to move higher. Now, based off of this multi-week consolidation, 4 weeks on a technical basis really isn't enough consolidation, especially when you factor in the volume trends and what we're going into. I mean, we still have basically, I believe it was 19 weeks of consolidation pivots over here that we're heading into. And really, we've only had 4 weeks of consolidation after a rip-roaring move from the year-to-date lows. 1 year performance in technology is now up over 6.6%. So it's starting to turn the corner in terms of having positive yearly gains in terms of 1 year period. Now, a few of the stocks that we have to pay attention to in technology. Obviously, some of the better performing stocks this year in terms of the year-to-date performance in technology areas like NVDA, Apple, Arista Networks, AMD, just to name a few. So we have to pay attention to those leading names, even like CRM. And a lot of these names, in my opinion, have had a terrific move off of the lows, and they are also running into additional resistance. For instance, CRM, which does hold a significant weighting in the XLK ETF, is running into this weekly 200 MA, as well as the weekly 100 MA. And then you look at the actual XLK itself, it's petering clearly above some of these major key moving averages. So although there's a lot of strength in some of these individual names, a lot of the individual names that gave the strength for this particular sector are running into key resistance. I mean, even if you look at Apple's chart, Apple has had a massive move trying to break out of this key resistance. We'll see if it keeps us in check. We have an upsloping wedge pattern that, yes, it could trade a little bit higher, but needless to say, you're at technical resistance here, and we'll have to see if we can get another weekly positive close outside of this key trend line. And then if we look at ANET, A-N-E-T, this is another stock that has had an impressive rally, actually breaking out into 52-week highs and trying to build another meaningful base. This actually looks primed and ready to move higher, but again, you do need more consolidation, and from a technical standpoint, this actually, in my opinion, is likely going to get a retrace back down to the breakout zone. I think that's going to be a good buying opportunity once the technology space gets some more healthy consolidation, or I should say if the technology space gets some more consolidation. But I think the buying level on ANET is right back down into support. Even if you look at NVIDIA, NVIDIA has had a rip-roaring rally. It is trying to break out of its little bit of a consolidation pattern here, but again, this is not enough consolidation going through this major breakdown point and this point over here. Considering, look at these volume trends, massive above volume trends above the key 20-week moving average, and then you look at these volume trends over here, way below. So I don't think NVIDIA is going to really make much higher highs past this 290 level. Maybe there's a shot it comes up to this 290 level, but I think that's when you're going to get a larger pullback to likely retest this breakout bar around 227. But until now, NVIDIA is holding up better than most people are expecting, including myself. But on a technical basis, on a fundamental basis, even if you look at the monthly chart, you've now had a beautiful 3-month bar surge right into resistance. This needs some consolidation, even on a fundamental basis in terms of its price to sales, price to earnings, and a variety of other metrics. But we spent a lot of time in technology because it is the heaviest weighting. But understand, many of these stocks in this particular indice are running into major resistance. So what's going to lift the technology sector higher from this potential flag consolidation pattern and try to break it out of this resistance when a lot of the individual names are, again, trading into resistance, even Apple per se. So time will tell. Pay attention to see if we get a weekly close above these key levels. If we get a weekly close above this major pivot high over here, then we're going to look for a second week to see what type of pattern builds off of there. But if you can establish yourself for over 2 weeks above this key pivot, this high pivot, or this breakout trend line, that actually will be a little bit more bullish for technology, and there's obviously some individual names in the indice that could continue to see some upside. Let's move along to the next sector, which is healthcare, XLV. XLV, notice how XLV had a big dip last week, tagging the weekly 100 moving average, and then it got bought right back up. So nothing wrong with XLV right now. The fact that it got bought right back up off that initial dip is bullish, but you need more consolidation again going into this resistance. Being the fact that you had a beautiful 5-week bar surge, you're now trading under resistance, and the big level, obviously now you have a major wick low. If you lose this major wick low, then you're likely going to test the low range of this wedge, or probably even the 200 weekly moving average. In terms of healthcare's 1-year performance, it is just up 1.24%. And in terms of its year-to-date performance since the start of 2023, it is down minus 1.71%. So even with the year-to-date rally that healthcare had from this massive move off the lows, healthcare is still technically negative. And what I'm watching for now is you're making a series of here's your low, here's your higher low, here's your higher low. So you have 3 higher lows, but you have a high and you have a lower high. The big question is, do we eventually take out this high pivot, or do we take out this low pivot? Whichever one comes first, that's going to be your big bullish trend, either break out or break down. If you lose this pivot, you're going to go test this 117 level around here. That'll be your next big support, may coincide with the pierce of this weekly 200. But if you can clear this pivot over here on a weekly basis, then you're going to test this double top high pivot. But again, I would not be going long healthcare names here, in my opinion. A lot of them have seen some weakness, but definitely pay attention to healthcare because it's more of the defensive sector. I'll pull up a couple stocks here that we need to pay attention to. Obviously, ALGN had a pretty big hit on earnings here. This is one that is still holding bullish alignment. And what I mean by that is you have this weekly bar surge. You had a big, nice consolidation pattern, an attempt at trying to break out of this down-sloping trend line here. You can see it at a peekaboo above there. Failed on earnings. This drop was primarily on earnings. It was a massive move down on earnings. But some buyers did come in and significantly held it off of the lows. And as of now in a weekly chart, this is still technically bullish. I mean, you have a low level around here, around 297, a pierce of 297 on a weekly close, to simply trade against. And realistically, if you wanted to let this have a little bit more room to run, you have a weekly low bar around here, around this 264 level. You get a weekly close below this wide range green bar, this pattern turns more bearish. But as long as you maintain this on a weekly basis still has the potential to move higher. I have a target of around 388 and then maybe even a pierce of 400 that ALGN can potentially get to. And then if you look at some of the other bigger names in there like United Health, take a look at United Health. So this chart is setting up to be a little bit interesting right now. You do have this wedge pattern near the highs of the chart forming, which makes me a little bit concerned. Right now you hit the 100 weekly moving average, got a bounce. Pierced the 100 weekly moving average, got a bigger bounce, but failed to make a higher high. So now you're still technically making maybe a potential formation of a downtrend. So you have your high here, you have a lower high here. Now you might be forming another lower high. If you take out this low pivot, you're going to go test this 392. So this is the dangerous part about UNH and some of the healthcare stocks. This held such a sharp weighting in the overall XLV that if it starts to break some key levels, you're likely going to see some more downside. Now J&J is another one on the short radar. One of the reasons on the short radar is if you simply look at this major trend line, pivot to pivot, you broke it here, confirmed. Now you've done a beautiful technical retrace back to resistance. So if J&J, which is the second largest holding in the XLV, starts to roll over and get rejected at this key neckline, this pattern has a downside of all the way to 135. Basically this white trend line here. So just pay attention to those couple leaders because they will be either headwinds or tailwinds for the overall healthcare sector. And the healthcare sector does have a pretty large weighting that we have to be aware of nonetheless. All right, let's move along to the financials. So XLF, and there's some interesting news regarding the regionals again. Obviously, we had another regional bank, which I'll touch base on in this video, FRC, getting completely demolished, basically being put in receivership. So that's obviously very detrimental for the regional banks. Now, One thing I will put into your perspective about the XLF, I still remain bearish. People think the banking crisis is over. It's absolutely not over. And that's why we have to be very, very on guard of potentially something else negative happening. One of the things that I'm first looking at on a technical basis is XLF is still trading below this key trend line. That's a major, major trend line that XLF is currently still trading below and trying to recapture at this point in time, but it's not doing so at this moment in time. So as long as XLF trades below this key COVID trend line, this pattern does favor a more of a break to the downside. Short-term positive for financials. You pierced the weekly 200, never confirmed on a weekly, and now you've recaptured it. That is a short-term positive. If you start losing this weekly 200 again, this pattern is going to want to take you down to about this $28 level, and then potentially, if there's more banking issues, down to this major $25 gap fill area. So just be wary that this is a bearish wedge formation that is occurring inside of this pattern. So if we had to remove that trend line, this is an inside bearish wedge. This bearish wedge pattern takes you to about, a break of this pattern takes you to about a pierce of this $28 level. So just keep that in mind for financials, that there is potentially a move down to about the $28 level based off of a bearish break. Now if you can recapture and get above this wedge and really start consolidating above the upper wedge, that may be a little bit more of a positive, but you're still into this heavy wide range red bar sell-off, and that is truly going to be your line in the sand. You can even draw a beautiful trend line connecting those pivots and those, and if you wanted to short the XLF sector, you simply use a stop loss above this red bar high on a weekly close or above this key trend line on a weekly close. But this, at the moment, I still remain more bearish on financials, even though the earnings reports have been coming in better. But we're discussing FRC, First Republic. That's another bank that's being taken under and potentially being acquired by either JP Morgan, which will pull up JP Morgan chart. Let's just run through some of these financials. JP Morgan, obviously reporting good earnings. Let me remove some of these trend lines here. So if we look at JP Morgan's chart, JP Morgan has clearly been under pressure, but off of that good earnings report, it has been able to recapture and trying to hug the weekly 100 moving average. Now, the short-term negative that I'm witnessing right now, you had your big impulse move on earnings, which popped JP Morgan up to the weekly 100. You got a weekly close above the 100 last week, and then this week it got rejected off of that same level. So you really want to see JP Morgan establish itself above the weekly 100 moving average if this doesn't turn into another downtrend. One thing I am observing again, first lower high, second lower high, third lower high. If this turns into a fourth lower high and then you break this consolidation, that is extremely, extremely bearish for JP Morgan. Even if we look at some of the other institutions, Bank of America lagging. I am ultra bearish on Bank of America. You have a trend line there, you have a trend line here, which you've broken. This is all bearish wedge consolidation. I still have a price target of 25, and then even this 23 level that needs to be tagged for Bank of America. Clearly lagging the financials. If you look at Wells Fargo, WFC, another lagger, not participating. Again, you've broken this key bear flag wedge over here. You got a perfect retrace, rejected at the weekly 200, which is this turquoise moving average, and you got rejected twice. This is another bearish wedge that is forming on Wells Fargo, and this has been one of the, full disclosure, I am shorting Wells Fargo, but this is one of the more bearish stocks that I do see in the banking sector, which is why you're seeing a lot of this bearish formation still occurring in the overall XLF, despite JP Morgan, one of the larger holdings, not putting in that same pattern. So one of two things, either JP Morgan's leading or the rest are lagging. And I think that is pretty clear and evident. The rest are definitely lagging. And the big question is, are the rest going to pick it up, or is JP Morgan also going to falter? Now, interesting to see PNC putting a buyout for First Republic. So PNC is the largest regional bank, and PNC is also looking bearish. You had your bearish wedge, clear breakdown. You've had multiple weeks of trying to get above this key area over here where you broke down. This initial high volume reversal candle, you're still all trading in that for now 1, 2, 3, 4, 5, 6 weeks. Clear distribution is happening here. Look at the amount of shares being exchanged down here. which means that there's still heavy sellers lurking in this PNC. And if PNC is buying out or taking under First Republic, I bet their credit default swaps are going to explode a bit higher and probably put pressure on the overall stock. If they're assuming a lot of the risk that First Republic had, that is very troublesome. And although they're probably doing it at a massive discount and premium, those liabilities are still liabilities at the end of the day. And yes, you could be taking them out for a lot less, but you never know how deep those liabilities could fall if things get really nasty with a high interest rate environment, net interest margins being squeezed, and ultimately a recession coming to fruition. Now, in terms of the best performing financial, let's just discuss, since there's a lot of weakness, we want to look at some of the more of these strength stocks. So FSIV, Fiserv, is one of the best performing financials this year in the XLF. It's actually up over 21% this year alone. So year-to-date performance is up it's up 20.83%. Clearly on watch for a technical breakout. Even if you had to draw a trend line here, if you get a second weekly close above this pivot, you could wait for consolidation to go long FISV. Clearly, this one has been a beneficial gainer of the weak regionals and some of the weaker other major banking institutions. You look at ACGL. This one's showing also great relative strength, breaking out to new highs. Now, would I chase this after a, 1, 2, 3, 4, 5, 6 week rally? Absolutely not. But just to put you into perspective, there are stocks out there that are trying to make meaningful moves to the upside. Another one I'm watching, FleetCor. This one's a potential long opportunity. It's had a little bit of an impact, and now you're trying to consolidate on that trend line to make a move to the top of this channel. If we get another week of consolidation right on this trend line, I'm going to forecast this right now that this will make a move up to the weekly 200. But it's basically based off of this consolidation. Now, I'm going to be looking at this as a long opportunity, but again, if you lose this green bar in a weekly close, then it turns very bearish, and you're likely going back to this 176 area until you hit your next support. So definitely pay this with a close, tight stop loss if you do go long. Stop loss on a weekly close is below this green bar. And then you look for a potential move to the upside on that. So there are pockets of strength in the financials, but lots of weakness as well. Let's move along to XLY. So consumer discretionary is interesting. We've been talking about this potential inverse head and shoulders. It still has not triggered. And the bearish thing is that this 100 weekly moving average is sloping down, and you also have this weekly 200 sloping down. So the aspect of the XLY ETF that I don't like is you're trading under that weekly 200. Definitely lagging the overall S&P and the NASDAQ market. And if you look at some of the components of the stocks that are lagging the overall XLY, look at Amazon. Amazon just reported earnings, and if Amazon holds such a great weighting in this ETF, and Amazon was rejected, it had a pop all the way up to about this 120 level. What was it, 122, sorry. It had a pop basically the top of this channel on earnings, and it got reversed in the regular trading hour session. So you don't even see that Amazon was rejected at that 120 level, which you know there's massive sellers lurking. And why did it get rejected at that 121 level, 122? Not only do you have this beautiful parallel channel, but you have this wide range red bar breakdown. So those same sellers that finally got break even there got rejected and pushed it back down. So if Amazon is showing a tremendous amount of weakness despite a beat on their earnings, that is not positive for this overall sector. And then you look at Tesla, another important market leader in this particular ETF that has just been really taken to the woodshed on its earnings report, but it's trying to bounce, and it did put in a weekly doji candle. Now, the interesting thing about Tesla is so many people have piled in on the bearish side. And one aspect that I'm witnessing here is that although XLY and the consumer discretionary stocks are looking a little more bearish at this point in time, I'm thinking that they're actually going to get a bounce. I think the XLY ETF is likely going to make an attempt to break out of this inverse head and shoulders. I think XLY is going to be one of the sectors that sees capital rotation. I think we're going to see capital rotation out of the XLK and back into the XLY. So names like Apple, Microsoft, NVDA, I think you're going to see the capital rotate more into the names like Amazon, Tesla, maybe Home Depot. You know, obviously there's some aspects of the XLY like McDonald's that could have some consolidation, where you could see McDonald's take a sell-off and capital rotates more into Tesla or Home Depot or Amazon. So pay attention to the capital rotation aspects of this market, because this sector is looking very skewed. You have major weakness in Target. You're looking at Lowe's also putting in some potential bearish consolidation. Then you look at Starbucks trying to break out to new highs and going up into some massive resistance. You look at some low volume names like O'Reilly, which are on a massive tear. Then you look at Dollar General, which is putting in bearish consolidation to move lower. You look at Chipotle Mexican Grill breaking out, hitting new 52-week highs. And believe it or not, there are some potential levels that I would look to maybe short on Chipotle. But I have, based off of this pattern, if we got one more, this is actually a massive level, and I have day traded this in the live trading room on YouTube for a nice win where we've shorted Chipotle. But Chipotle, if it hits 2100, it's an absolute short for me. Chipotle above 2100, I'm looking to accumulate some shorts, and this would just be for a simple little minor pullback. So notice there is weakness in this particular sector, but a lot of the names are popping out to new 52 weeks highs, which we have to certainly be paying attention to. And obviously CMG is the best performing stock in the overall XLY ETF. But if we get a move past this neckline, then you're likely going to test this 158 on the XLY, which would mean that there's likely going to be a little bit more upside in, say, Tesla. And considering Tesla finished with a weekly bottoming tail doji right off this key parallel channel line, it is likely you retest this weekly 200 around 178, maybe even a pierce of 180. So pay attention to some of those leading names. In terms of the year-to-date performance, XLY is up 14.48%. In terms of its 1 year performance, XLY is down minus 12.8%. So clearly it's still down in terms of a 1 year period, but since the start of 2023, it is starting to make a meaningful comeback. Let's move along to the next sector, which is communications, XLC. So XLC, notice how you are doing a nice little trying to break out here on a weekly technical basis. There's confirmation is on watch for the communication sector. You are now breaking out of this bottoming formation, this inverse head and shoulders, which means that communications could have more upside. First off, you'll have resistance at the weekly 200 around 61.50, give or take 62. Then you'll have your second resistance at 64. But if this pattern breaks out, the upside actually takes you to above 70 if you were to have a measured move of this pattern. Now, it's not a straight shot there because communications have already had a massive rally this year. I mean, in terms of its year-to-date performance in communications, we're talking about a whopping gain. It is the best performing sector, up 24.82%. In terms of its 1 year performance, communications are basically just flat, up 0.033%. So with this rally last week, communications on the 365-day trading session just hit the positive marker, recapturing some key yearly losses. And it'll be interesting to see how communications performs. And let me just be clear, one of the reasons communications is breaking out here is simply because of one stock. And communications is actually one of the more, deceptive ETFs to follow. And why I use that choice of word deceptive is because the weighting in this particular ETF is the worst weighting in my opinion. It is absolutely the worst weighting. So this is one of the smaller sectors too. It only has 25 stocks in this particular ETF. And the largest stock, which is Meta, has a 24.36% weighting. Almost a 25% weighting in Meta for the stock. We're talking about 0.25% of this whole ETF relies based off of Meta's moves. So if Meta is up, you're likely going to see this stock up. And look at the distinguished breakout. This is basically where I'll show you on a trendline basis. So the ETF is basically trading around here, this potential little breakout area. But Meta has had basically 7 additional weeks of rallying, coming up, piercing some key necktie moving averages over here. And then you look at the XLC ETF, it is clearly lagging Meta, just on the verge of trying to break out and catch up. Now what this tells me is because Meta has had such a powerful run, and actually physically broke out, and it holds a weighting of 24% in this ETF. This tells me there's so much weakness in the communication sector, because if Meta holds a quarter of the full weighting out of an additional 24 stocks, when Meta moves, this ETF should be flying. And if the majority of the stocks in this ETF were performing like Meta, this ETF would be flying up. And when you look at, just scroll through some of these charts, Verizon lagging, Google lagging Meta, T-Mobile getting a little toppy, trying to potentially break it down. Netflix is finally also lagging. LYV lagging. Charter Communications, CHTR lagging. Disney also announcing layoffs. This one's also lagging way below the moving averages. Meta's pierced its weekly 200 and its weekly 100, just to put it into perspective. You look at Warner Bros, also lagging. Let's look at AT&T here. Also lagging, way below its weekly 200, which is up here, and its weekly 100, which is there. You look at Fox getting absolutely slaughtered. Paramount. So there's tons and tons of weakness in this particular sector. Not all of this sector is performing, which means that if Meta runs out of steam, which is why I'm finding this sector a little bit more overbought and reluctant to believe this breakout, is because if Meta runs out of steam, which on a technical basis it absolutely looks like Meta should, Meta's gone absolutely parabolic, this particular sector is going to see some downside pressure and consolidation. But time will tell. Definitely going to be interesting to see how this one plays out. Let's move along to the industrials, XLI. So in terms of XLI's performance, it is up 1.82% year to date. In terms of its 1 year 365-day performance, industrials are up 3.58%. Now industrials are putting in this very choppy consolidation pattern. I'm still remaining that this is distribution. I am not really seeing that much accumulation. I am seeing more distribution, and distribution patterns are very likely and probable to see more downside. Basically, some of the important names in this particular ETF to follow are GE, UPS, which, interesting enough, UPS got slaughtered, and some of the transports are actually making bearish closes on a weekly basis. Look at that trend line. Got a weekly close below there. BA is also holding up, but trying to put in consolidation to move higher. You look at, let's do a look at FedEx. FedEx has been in an uptrend, trying to move higher. You look at VRSK, which is an important one. That's trying to trend higher as well. But some of the transport stocks in this particular ETF are at very, very vulnerable. And then I'm also noticing a lot of the steel stocks in the industrials, like Nucor, NUE, Steel Dynamics. A lot of those stocks are the ones that are under some near-term pressure. I mean, if you just look at some of this Nucor stocks, trying to potentially get a little toppy formation here to try to trigger. You look at STLD. So Steel Dynamics also potentially on watch for a triggering of this head and shoulders. And the reason why I'm showing those two leading stocks that haven't triggered its head and shoulders, if you look at CLF, Cleveland Cliffs, this is an industrial that actually is looking a little bit more bearish and likely to trigger some more downside based off of the key trend line breaks over here. So definitely pay attention to industrials, because there's distribution patterns going on in this ETF. And if industrials start to see more downside, that's usually associated with less economic output, slower GDP, declining GDP, which is obviously very, very important to be paying attention to. Let's move along to consumer staples. Consumer staples have been absolutely on a tear. And on a technical basis, consumer staples have actually confirmed a weekly breakout. Now, what this means is that any dip back to support, which would basically be this trend line over here, could be bought as a long trade on consumer staples. The fact that you've broken out of this key trend line leads you to suspect that meaningful consolidation, specifically sideways to downward consolidation, could be bought. Now, this is a weekly chart pattern, and you have had a 1, 2, 3, 4, 5, 6, 7. So I'm going to be clear that chasing this price action off a 7-week rally off of a breakout is not very wise in my opinion. I certainly wouldn't be doing it, but any meaningful consolidation could be bought. I do think that this sector does have a pullback at the minimum, trying to retest this 75, maybe even this down-sloping trend line. Notice you are into this resistance pivot, this pivot, this pivot, this wide range red bar breakdown zone over here. this massive pivot zone. So there is tons of resistance just basically in this proximity over here that we have to be mindful of, which is why I think that the XLP needs to do a lot of backing and filling and chopping in this range, preferably touching that downsloping trend line before it breaks out. And one of the reasons consumer staples have seen such an inflow of money is because people are going to safety. In times of stagflation, inflation, low economic growth, people flee to the staples that they know have a consistent cash flow, have good revenue-based businesses. The things that people need to survive are going to be purchased. Now, in terms of staples, 1 year performance, it is up over 3.88%. And in terms of its 365-day performance, it is still down minus 1.68%. Let me just pull up some of the XLP goodies in here. So staples, some of the important names. In terms of the best performing stocks, there you have Lamb Weston. LW has been a standout performer in this particular ETF, clearly breaking out here, or it has broken out. It is parabolic extended. You look at Church and Dwight, full disclosure, I am shorting this name, but basically CHW had a big pop on earnings, and you can see that it is trying to peak above this key trend line over here, but you're into massive support in a very extended move right now, and I do think that any second additional weekly close above this key pivot zone over here just stops you out of the trade. But until now, I think you get a pullback back to the weekly 100, this original consolidation zone. But there's obviously another important one is CLX to pay attention to. Clorox has been a clear breakout. This one I do believe has more upside if you get consolidation. I think these patterns are very overbought in the near term and need to see some more downside movement. In terms of some of the worst performing ones this year, you have KHC, Kraft Heinz, which is interesting. So KHC, let me just pull that up. KHC has clearly been lagging this particular ETF, and if we get a pullback in the consumer staples, this is a potential short candidate to, because it has been lagging. And then you look at JM Schmucker as well, which is SJM. So that has been another potential lagger in the sector. It hasn't broken out yet, but you do have a pretty much a clear level to watch for a breakout. You look at Kellogg's, which is the K symbol. That one has also been lagging and compared to the overall ETF. It is actually the third worst performing in the overall XLP ETF. But nonetheless, it'll be interesting to see how some of these names shape up. Let's move along to XLU, the utilities. So if we look at utilities, utilities are on watch for another breakout here. This is getting nice, beautiful consolidation to move higher. This pattern here, the fact that you broke out off of this green bar, and now you've had 1, 2, 3, I'm watching this sector very closely for some long opportunities because it is getting the necessary consolidation it needs to continue to move higher. And you always want to have the overall ETF behind you as a tailwind to push individual long names higher. You never want to have the ETF as a headwind because it always makes longs that much more difficult. In terms of utility performance, it is still down minus 2.16% year to date, so it is clearly lagging, but based off of this bullish consolidation, it may be on the precipice of catching up to the majority of the other sectors. In terms of utilities 1 year 365-day performance, it is down minus 5%, just down minus 5%. And what I'm watching in this particular ETF, some of the impressive movers have been like EIX, which is clearly on watch for a technical breakout. You haven't fully confirmed above this key trend line over here, but it is on watch nonetheless. Then you look at NRG. That has been an impressive, it's a lagger in the overall bigger grand picture since this 2022 movement was very negative. But right now there are a little bit of short-term positive. The fact that you're holding above this green bar impulse move leads me to think that you can potentially move a little bit higher. But nonetheless, we have to be very careful with this pattern because you are putting in a much larger monthly bearish consolidation pattern. This is a potential short candidate, but only once the market tops and only once the utility sector tops. If you get a failed breakout on the XLU, this becomes a very likely short candidate because it is lagging the overall sector as a whole. If you look at ED, another important name to pay attention to, this one's a 3.49% weighting in the sector. You're running into some resistance, and you could be putting in a failed lower high. So here's your high. this might be another lower high over here. Another big weighting in this is SO, so Southern Copper, Southern Company. Southern Company has a 7.99% weighting, and what I want to bring to your attention is Southern Company is running into resistance. If you take a trend line from your COVID low to your massive pivot low bounces over here, your breakdown zone, big bar down, your retrace got rejected, you're now doing another retrace, and notice how the volume is starting to come in. There was a lot of buyers there to keep it up off of the lows, but let me be clear, there were definitely sellers lurking in that range. So definitely be paying attention, because it doesn't mean that the XLU can't break out. It just means that maybe we need more consolidation. If Southern Copper or Southern Company is one of the bigger names in this particular ETF, you definitely need to pay attention to that, because it does mean it may need consolidation. The actual biggest name in that ETF is NEE. And I'm not liking NEE, Next Era Energy's price action right now. Although it is holding the weekly 200, and you did get a big flush dip, likely on earnings here, but it managed to recapture and hold this weekly bar. That's a short-term positive to move higher. But you're still nonetheless putting in a series of lower highs, which means you're in a technical downtrend from this point on, and you're just putting in this wedge pattern at this point in time. So I myself wouldn't be going long utilities just quite yet, based off of some of the larger holdings showing me that they need more consolidation and time. But at this point in time, there's some interesting individual names in the utilities that you certainly have to pay attention to, because they are looking a little bit more bullish. Let's move along to real estate, XLRE. So XLRE is trying to make a break off of this beautiful impulse green bar. You had consolidation. It's trying to break out, but notice you still haven't broken out of this hammer reversal candle on XLRE. In terms of the real estate performance, its year-to-date performance is up 2.22%. In terms of its one-year performance, it is down 21.3%. Still lagging the overall market, and it makes sense because rates are still going higher for longer. Jerome Powell hasn't pivoted, which is why real estate is still lagging. There are some individual names that you have to pay attention to: Regency, Welltower, AMT, Kimco. I mean, there's a variety of different names. I won't go through the charts because they do hold much of a less weighting in the overall S&P and market, but definitely take a skim through some of those names, because they are worth looking at for potential trading opportunities. Moving along to materials, XLB. Initially in the beginning of the week, it was under significant pressure, and then it got bought right back up like nothing was wrong. In terms of its year-to-date performance, it's up 3.69%. Materials, in terms of its one-year performance, is down minus 5.6%, but you're at resistance. You're at the weekly 100, and notice how you've challenged this weekly 100 once over here, a few times over here, a few more times over here, and you keep getting rejected off of that level. What materials are showing me is, again, distribution, accumulation, bigger distribution, more accumulation. Sellers are unloading into the new buyers trying to buy this trend higher. I do not like the fact that you're putting in a mini upsloping wedge pattern right underneath resistance. I'm seeing these wide range red bars forming. I'm seeing heavy distribution volume coming in, and I'm not liking this overall consolidation pattern for the materials sector. So I'm in the camp that materials have to go a little bit lower. Maybe it's coinciding with more and more weakening GDP. Obviously, we have been having GDP cut by the Atlanta Fed quite a few times. It's now sitting at 1%. We'll see if they make more cuts, but pay attention to the sector because it is super sensitive to the overall GDP output. In terms of some individual names to pay attention to, let me just scroll through the XLB chart here. The best performing name is ECL, Ecolab. Okay? So Ecolab is actually the best performing name in this particular sector. And Ecolab is trying to break out of this bullish consolidation pattern. Notice how you had a downsloping trend line. You broke out, second week, pullback, huge reversal. This looks primed for more upside. Some of the lagging names in this particular name, like I mentioned earlier, STLD, some of the steel stocks, potentially on watch for a bearish breakdown. We'll keep a name on that. But in terms of the laggers in this ETF, you have CF, which is one of the worst performing ones right now, putting in bearish consolidation to move lower. I think CF hit the weekly 200 based off of this nasty consolidation that is occurring. It is still down a lot, but definitely pay attention to it. And then you look at some of the lithium stocks. They were hit pretty hard as well. They have had a bounce off of the lows, but again, what type of consolidation do you get inside this bar? Is it bearish or is it bullish? Right now you are at some support. I still have some of these lithium miners maybe going a little bit lower, but you are into some good support. Valuation on a price to earnings ratio are some of the cheapest for Albemarle Marley, so this stock is actually favored to get more of a little bit of a bounce, but it is lagging with this recent down move that it had in the overall materials sector. So I mean, in 1 week, this sector fell from the high to the low, or this stock fell about 19% off of the Chile potential nationalizing the mines, the lithium mines. So pay attention to a few of these individual names. It'll be interesting to see if some of the laggers become leaders and some of the leaders become laggers. But Ecolab definitely doesn't look like it's going to lag the market. It looks actually poised to attack this wide range red bar around 175. That actually may be a little bit of an intraday trading opportunity for a few days, just for the very nimble, savvy traders that are out there. Let's move along and finally touch base on XLE. So energy sector was strong. It actually finished off of the lows, up 1.55% last week. It is still lagging year to date, down minus 2.68, but it's still positive of its 1 year performance. It's actually leading the market, up 15.13% over the last 365 days. Clearly above all of the moving averages. I still think I'm seeing lots of distribution in this particular sector, and I do think that if oil, really this is from an oil standpoint, if oil starts to break down, which is what I'm kind of maybe seeing in the near term, at least back down to this $70, $66 level, oil and XLE should see more downside. One of the strong names in this particular sector is XOM, which is clearly into this double top. It did fill the gap, but once again, it's hitting a multi-year wedge that goes all the way back to some major highs way back when. And if you look at its counterparty, Chevron, CVX is actually lagging. So I find that very interesting that XOM was leading, but Chevron is lagging. Typically, these stocks move in very high correlation and proximity, and I do think that XOM is going to be the likelier candidate to fall and catch up to Chevron, especially since Exxon may be having a potential buying deal with PXD, which they may do some share and cash dilution. On that note, thank you all for tuning in. This one is a bit lengthy at the moment, over 43 minutes, but I implore you to continue to study the weekly charts, the longer term patterns, because they do eliminate a lot of the noise. Please give this video a big like down below, and we will see you on the charts tomorrow. Happy trading. Good luck, everybody, tomorrow.